Hi, I'm Christina Hageny, president of Valor Payroll Solutions, and we work with small business owners to help them with their payroll. So, a lot of our clients are S Corp owners, which means they have done the S Corp election with the IRS. One of the biggest requirements with the S Corp election is that the owner puts themselves on payroll and pays themselves a reasonable W-2 wage. Now, the IRS doesn't specifically define how to calculate a reasonable wage, and that's not what we're here to talk about today, but make sure that you check that out if you're an S Corp owner and that you're paying yourself properly. So a lot of times we are giving information about what you should do, and we're going to pivot a little bit today and talk about what if you don't. So if you're an S Corp owner and you do not pay yourself a reasonable salary, or more importantly, pay yourself any W-2 wages, there are a lot of things to keep in mind before continuing to not put yourself on payroll. So the benefit of the S Corp election is that you save money on taxes. This is done because as an S Corp owner, you're supposed to pay yourself a reasonable W-2 wage. Now, those wages are subject to Social Security and Medicare tax. Half will come out of your employee paycheck and half will be a business expense that you pay as the employer. But in this scenario, you are both the employee and the employer. So the combination of the employee and employer Social Security and Medicare tax is 15.3%, which should sound familiar because that is the same percent that you pay in self-employment tax if you're not an S Corp. So if you're not an S Corp, you pay that 15.3% on all of your net business income, and that's it. You pay tax on all of everything that you earn. With the S Corp election, you're only paying the self-employment tax, but again, that's Social Security and Medicare, half is the employee, half is the employer, on your W-2 wages. And that's why the IRS cares so much that you pay yourself that reasonable W-2 wage. Now, what we see a lot of times is S Corp owners start working with a new accountant, and their accountant tells them, oh, you should be doing payroll for yourself. And then we start going through all of these questions. Well, why was this never brought up before? And why would I start doing that now? If you're an S Corp owner and you're paying yourself absolutely zero W-2 wages, this means you are completely evading self-employment tax. And as you can imagine, the IRS does not get very happy about that. So again, that's why you have to pay yourself that reasonable W-2 wage so that you're still paying self-employment tax on some of your business income. If you pay yourself $0 in W-2 wages or an extremely minimal salary, you're still basically evading that tax, and that's where you can get in a lot of trouble. So if you get audited and the IRS decides that you have not paid yourself a reasonable W-2 salary, they can actually come in and reclassify as much of your distributions as they see fit as W-2 wages. And I assure you that the amount that they decide as reasonable will be far more than what you could have done and not have been subject to the audit or not have gotten the IRS to reclassify. So you want to be able to justify your reasonable W-2 wage. Because what you don't want is the IRS to come in and they'll decide what that reasonable W-2 wage is, and it's probably going to be a lot more than the 60-40 rule, for example. They're going to classify the majority of your business income as W-2 wages. If this happens, now you have to go back and file or amend all of your payroll tax returns, which means you will have additional payroll taxes, plus you have penalties and interest for late filings and late payments. This is a huge chore in and of itself to go back and amend all of your payroll tax returns, which of course would also include a W-2C or a W-2 if you didn't give yourself one in the first place, which in turn would then require you to refile your business and income tax return for that year or those years. Taking it a step further though, you can actually get in trouble for evading the tax if they decide that it was willful, and you risk losing your S Corp election entirely, which means you would be right back at step one where you are paying 15.3% in self-employment tax on everything that you earn in the business. So it makes a lot more sense to be fair, to figure out what that reasonable compensation is, and to get payroll set up and make sure that you are in compliance. If you don't, and the IRS comes knocking, again, they're going to reclassify those wages for you. It's going to be much more than you could have gotten away with. I don't like using that terminology because the whole point is not to get away with anything, but you could have justified a lower reasonable compensation than what the IRS will determine as your reasonable comp. You're going to have a ton of work to do, filing or amending payroll tax returns, filing if you didn't pay yourself anything at all, or amending if you paid yourself an extremely low salary. And then you might have penalties from the IRS. You could have evasion charges if you have been doing this willfully or for a long period of time. And then at the end of the day, you could lose your S Corp election entirely. So do the right thing. Make sure that you're paying yourself a reasonable W-2 salary if you're an S Corp owner. And of course, if you have questions or need help navigating this process, that is what we are here for. You can always find us online at valorpayrollsolutions.com.